Hi everybody, today I'm going to provide you an update on my three portfolios with the current value of 273,000 as of 30th of September 2025. The first portfolio is a stock portfolio that comprises of US and Singapore stocks and ETFs. For these portfolios, the key focus is mainly on income rather than growth. And I have set a cap of maximum 5% per counter, and also for Singapore market and US market, each market I will not have more than 15 stocks currently, and the number of stocks will increase when the portfolio size have growth. Now let's look at the changes I have made for the month of September. I have added in a new covered call ETF, which is IAUI, with new Gold High Income ETF. All the while, I don't invest in commodities, as commodity don't pay me dividends, and this portfolio key focus is on income. And then news have launched this covered call ETF that is on gold, and it pay a monthly dividend with an annualized distribution rate of 12.56%. I feel that you will be able to fit into my existing US portfolio, and thus I make a 1% stake on this portfolio. But do take note that this ETF is a pretty new ETF, which is just launched a couple of months ago, and thus it have not really been through any big market corrections. So how will it perform when there is a big market swing? It is actually untested, and thus I only take a small position stake of only 1% of the total portfolio to invest in it. As I mentioned, the portfolio is pretty new. We can see that it only start to pay dividend in June, and as of now, it only have a 4 month of dividend records. And thus, the 12% is an annualized returns based on the past few months of distribution, and we presume that the dividend will able to maintain and continue for the next 8 months, and this is how they derive the annualized return of 12.56%. So now let's look at my Singapore stocks. Currently, I have 13 counter, and none of them have crossed the 5% cap that I have set. The highest percentage holding is Mapletree Logistics Trust is 4.24%, but it is having a loss of 14.64%. And the total portfolio return currently is sitting in a 10% profit. As for the portfolio dividend yield at cost, it is currently at 4.93%. To me, the dividend yield is still low than my target dividend yield of 5 to 6%. And I still got 2 more space to put in another 2 counter that's listed in SGX. So I may need to make adjustment when the time arises, when the opportunity arises to get into some counter that are able to enhance the dividend yield of this portfolio. This table shows the market value weightage and the dividend weightage for the portfolio. From this table, you will able to see that SAS, SGX, and ST Engineering, for their dividend weightage, they are currently the lowest. However, for SGX and ST Engineering, of their price appreciation, in fact, they have contributed quite a big percentage to the capital gain of the portfolio. The one with the highest dividend weightage is Mapletree Logistics Trust, which contribute 11.3%, and followed by Mapletree Pan Asia Commercial Trust. However, these 2 counters are currently suffering losses, but from the share price movement, you can see that actually they are recovering, and the losses for the portfolio actually have come down. So next, look at my US portfolio, and my US portfolio currently have 15 counters, and Google actually have crossed a 5% threshold, and actually I have trimmed Google along the way to make it back to 5%. In short, that I'm taking profit on Google as it crossed the allocation target, and I use that money to go and buy the covered call ETF. And for this portfolio, the one that suffered the heaviest losses actually is Nike, which is at the loss of 28%. And the one that give the best contribution to the portfolio return, in fact, is Google and Bank of America. And from this portfolio, you can see I have three covered call ETF. One is the TLTW, which is a 20-year Treasury bond buy right strategy ETF. And I have the newest Bitcoin high income ETF and the latest addition, which is the newest gold high income ETF. And this is the yield at cost. From here, you can see the three covered call ETF have a very high dividend yield. And the three of them actually pay dividend monthly. And a lot of you will say that for US counter, there is a 30% withholding tax imposed on that. And this yield at cost is calculated after less of the 30% withholding tax. And just a point to take note that for the TLT and the TLTW, these two counter, because they are invested in US Treasury bonds and also due to the classification of the asset management company, these two counter actually don't have the 30% withholding tax imposed on them. So what you see, the dividend yield here is without deduction of 30% withholding tax. However, the total dividend yield for the US stocks portfolio actually is quite low, is 2.9%, but the capital gain is much more than the Singapore stocks, which indirectly have compensated for the lower dividend yield, which is quite normal for US stocks, which in general, the dividend yield is lower. So going forward, I plan to get one more covered call ETF to boost up the portfolio yield. However, when I have the 15 stocks here, so if I were to get one more covered call ETF, I will need to remove one counter from this portfolio, which I have not decided yet on which particular counter I want to remove. In fact, I have shortlisted three, but I will look at the market condition and decide when I will remove it and add in another covered call ETF just to boost the dividend yield for this portfolio. This is the market weightage and the dividend weightage for the US stocks portfolio. From this table, you were able to see the three covered call ETF all take up not more than 1% of the total portfolios, but the dividend contributions to the portfolio is the highest. However, to take note, covered call ETF may be much more riskier than stocks on normal ETF. And also the covered call ETF, when I buy the covered call ETF, I actually forego capital gain, as most covered call ETF were not able to outperform the market or outperform the underlying counter or index they are doing covered call on. So the focus of covered call ETF is mainly just for income purpose and not to outperform the markets. This is the stocks performance since January 2022. Initially, when I start this portfolio, I start with small capital and I slowly every month just add money inside, and thus the portfolio growth in respect to market actually pretty slow. And after end 2023, then the portfolio has started to gain traction, and you can see that the gap between the market values and the portfolio investor value have started to widen. And I hope that this widening will continue, as I will still continue to add in money into the portfolios to grow the investor capital, but at the same time, I will want to grow the portfolio values. And the gray bar is the money that is not invested. So initially, the amount of cash is not invested is on a huge percentage, but currently I only left less than 20% of the capital not invested. And they have been lower than 20% for quite a while already. And the cash balance I may even lower down to 10% when there is a better opportunity for me to invest in the market. And this is the dividend collected since this portfolio has started in January 2022. And over time, because of capital increase, because more capital injected, and also because of lesser holding on cash, the dividend have been growing over the years. And the total dividend collected since the portfolio started in January 2022 is close to $7,000. This is based on year. As for the annual dividend collected, you have seen that from year 2022 to year 2025 September, you will see that the dividend actually have really increased over time. One of the key things is more and more capital invested, and also due to more capital growth. I sell off some of the counter that make profit to take the capital to invest in some more stocks to get more dividends. As of September 2025, the total dividend collected already surplus 2024, and I still got 3 more months to go. My target is to able to cross 3,000 for the year 2025 for the dividends, and also the US counter dividend. The dividend collected for the US portion is still lower than 2024. So I hope that by end of this year, you're able to surplus 2024 dividend also. And let's look at the REITs holding in the Singapore and the US portfolio. For REITs, I will look at the two markets as a whole to build a REITs portfolio. So the portfolio comprises of Singapore and US REITs of different markets or different sectors, so that I try to minimize the overlapping of the portfolio holdings. So from the market weightage, this is the market weightage and this is the dividend weightage. From here, you were able to see that it's quite surprising that VG and Realty Income both are US REITs, and yet they are able to contribute, each able to contribute 10%, and this is after 30% dividend withholding tax of the dividends to the REITs portfolio, which they even contribute higher than CICT and even Fraser Centrepoint in terms of dividend weightage. Of course, these two counters have actually invested lesser also, as there's no opportunity for me to buy some more. This explains why VG and Realty Income can contribute more dividend weightage compared to these two Singapore REITs, as I invested more capital on it. And also these two REITs, their dividend have been growing year on year compared to Singapore REITs. For the past year, because of COVID, most of them, their dividend don't grow. But for the US side, their dividend still continue to grow regardless of COVID, regardless of market volatility in the past few years. Next, let's look at the other portfolio, which is a pure unit trust portfolio with focus on growth and not dividend. Because a lot of people invest in unit trust portfolio, they're looking for dividends. For me, my stock portfolio is focused on dividends, and my unit trust portfolio is focused on growth. So currently they have 8 counter. I have not made any changes for this portfolio for the past 1 month. I may going to make changes in the month of September due to a concern of US is at all-time high, and actually China is recovering. So I may want to reposition my portfolio to do some profit taking and do some adjustment to the portfolio. I'll keep everyone update once I make the changes in my next videos. And this is the unit trust performance. It have the same similarity as the stock portfolio during a starting phase, where it start to build in the build-out phase. It is not really performing, and it start to have the breakout also around December 2023, when the portfolio size also start to grow bigger, and the gap between the market values and the investor capital also has started to widen. And similarly, I hope that this thing will continue going forward. And this is the portfolio allocations of my 8 counter. And when I construct unit trust portfolio, I'm looking at volatility. That is a key concern. I try to maintain a 3-year standard deviation of not more than 10% when I'm constructing a portfolio, with a long-term 5 years target annualized return of between 7 to 9% returns. So this is how I construct a unit trust portfolio, which I do not looking at double-digit growth, which will make the portfolio riskier. So I prefer to have a volatility that is well within my comfort zone, which is 10%, and with the annualized return of 7 to 9% returns. Let's look at my last portfolio, which is a SRS portfolio, my supplementary retirement scheme portfolio. For this portfolio, it is not 1 year old yet. I've started end December 2024 with initial capital of 30,000. Then from there, I start to invest, top up $500 every month into this portfolio. And do think that this portfolio is US-centric. What do you mean by US-centric? 70% of the money will invest into the US market. What does it mean? That the investment currency will be in USD, while the other 30% will invest in unit trust, mainly focus on growth unit trust, and the invested currency will be Sing dollars. However, this unit trust will have US exposure also. This is why I call this is a very US-centric portfolio, where more than 70% of the money will be in the US market. 70% I invest into 6 ETF and also cap 3 US stocks. And for the other 30%, I currently do not cap any how many unit trusts I will invest, but of course I will look at the amount the portfolio have to decide how many unit trusts I will want to invest in on that. So this is the current allocations, which comprise of currently it comprised of 6 US ETF, 2 Treasury ETF, 1 S&P 500 ETF, and 3 US sector ETF. And for this, we currently have a US stocks called United Health Group, and unfortunately, it is suffering a losses because after I bought it, the share price continued to drop. As for the other 30%, which invest in global unit trust, currently I have 3 unit trusts inside. One is a China, JPM Greater China Unit Trust, which is the latest addition I just add in September, followed by 2 global funds and 1 technology funds. Currently, I still have a cash about 20% sitting there not invested at this juncture. So this is the newer addition, which is the JP Morgan Greater China Fund that I have added into this portfolio. I just add in a 3% weightage to it to capitalize on the recovery play of China. From here, you can see on the midterm wise, this JP Morgan China Fund actually didn't outperform the market. But in the past 1 year, in a long-term perspective, this fund have outperformed market. So during the past few years, most of the China fund are not able to outperform the market due to the volatility of market. And thus, it is hard to find a China fund that have consistently outperformed the market over this time zone period. I picked this fund because of what they have invested in, and I prefer a Greater China fund rather than a pure China focused fund. So this is the allocation for my this SRS US-centric portfolio, where 40% will invest in US sector ETF, 20% will invest in the SPY and IEF, where I do a balancing on a monthly basis, when 30% will buy into unit trust and 10% will go into US stocks, where I kept it at 3 US stocks. Currently, I only have 1 for this portfolio. And this is how this portfolio has performed since started in December 2024. In fact, it suffered losses during the correction in April, where the whole US market come down. This portfolio actually has suffered losses, and it is on a recovery mode. And finally, it had managed to recover and turn positive for the month of September. And from here, I hope that the market value and the investor capital, the gap can be widened going forwards. So these are the updates of my 3 portfolios. And if you feel that it has benefited you, do remember to like and share, and also leave your comment below. I shall see you in my next video. Thank you.